Good morning, this is Larry Edelson for my Uncommon Wisdom video for Thursday, May 6th. Lots of action in the markets, lots of action in the fundamentals underlying the markets this week. Most of everybody's attention is on Europe and Greece, and so far this week we've seen Europe pitch in about 146 billion to bail out Greece. However, one day the deal's on, the next day the deal's off. So we're seeing some violent reactions in the markets. We're also seeing more focus on Spain's problems, Portugal's debt problems, and the sovereign debt crisis in general. And it's really heating up, this sovereign debt crisis. So again, this is going to be a focus for the next several years as this thing moves through Europe and then across the Atlantic to the United States, the most indebted country on the planet. So everyone has to pay attention to this. Let's take a look at how it impacted the markets this week so far. In front of you is the gold chart that I've been showing you. Initially, gold gave us that buy signal, 1162, that I alerted you to last week. And gold exploded higher up to about almost 1192 on the nearby futures contract, 1190 and change in the spot market. And then we saw some selling yesterday that brought it back down to the 1168 level. Yesterday's sell-off in gold shocked quite a few people. But as you can see from this chart, gold moved up to the upper part of this channel, indicated by this rising dash line, and then it fell back to test support at that 1162, 1168 area where the buy signal originally came from. So that's perfectly normal market action. I do believe very strongly that gold has begun an entirely new phase higher. We saw this rally occur mostly with a rally in the dollar, which most people would not expect. That indicates, and indeed in terms of the euro, we've seen gold move to a new record high this week in terms of the euro. But gold moving up along with some strength in the dollar is very, very strong indicator of the bull market in gold. If it can move that much higher with the dollar going higher, imagine how much higher gold can go when the sovereign debt crisis hits the United States and the dollar really starts to tank. So that's something you need to keep in mind. If you've been following my recommendations in core gold, you should be long core gold. You should not be phased out by any of the gyrations there. If you're a shorter term trader, you should be watching my signals. I am currently very bullish now short term on gold, expecting it to begin moving stair-stepped higher to new record highs. And I say stair-step because don't expect gold to go straight up, okay? And as a matter of fact, you do not want to see that. What you want to see is gold rise, come back, test support, rise higher, and see a series of higher highs and higher lows on the charts. And that's already what gold is doing. That's a healthy sign of a bull market. A market that just blasts off like a rocket and goes straight up is very exciting to everybody who's in that market, and to those who aren't in the market, they feel like they've missed it. But those kind of moves are actually more bearish than bullish. So keep that in mind for gold and investing in general. When you have a good solid bull market, you want to see it move up, pull back down, move up again, pull back down, etc. And take a bigger picture look at a bull market when you're in that market, so that you're not shaken out by those zigs and zags, which take out most rookie investors, even experienced investors. Let's now take a look at the dollar. The dollar has soared like gold on the back of the sovereign debt crisis sweeping through Europe. That is not surprising to me. We have gotten through the 82 level on the dollar index, which is significant. I think the dollar can go higher in here on a short-term basis. Relative to the dollar index, it could move to 85, it could move to 87, it could even move all the way up to 89. another 5 or 6% higher on the dollar. But you have to bear in mind that this is all in the confines of a long-term bear market for the dollar. When the sovereign debt crisis hits the United States, and that could be as soon as next month or 6 months from now, the dollar will react violently to the downside, and over the next few years we'll see the dollar fall dramatically as the sovereign debt crisis tears up the balance sheet of the United States government, and as Washington deliberately takes steps to print money and devalue the dollar to try and inflate away the debts. If you think their money printing so far and their money spending so far has been a lot, you just wait and see what happens when the sovereign debt crisis hits this country. And I assure you it will. Let's now take a look at the Dow. The Dow, on my charts, I've been following for you how it got up to 11.2 and change. We did see some struggling there, and as the sovereign debt crisis began to flare up again in Europe, we saw some selling. Notice how the Dow came right back and held on its violent sell-off on Tuesday, and on Wednesday, this support level at 10.9. This is an important support level. There's more important support at 10.6. I would not be surprised to see the Dow pull back to 10.6. That would be normal, and then try again for new highs. However, over the last few weeks, I've noticed, I've indicated to you that we are in a topping phase in the Dow, and before the next big move up in the Dow occurs, we're far more likely to see 9,000 than 12,000 on the Dow. Excuse me. So I don't want you to be aggressively long any stocks except for natural resource stocks and gold stocks, which are, again, tangible assets. Let's now take a look at oil. Oil's had a pretty violent move back down. You can see very choppy here. We got up to 87 and change, down to 81, back up to 87 and change, down to 81. Oil is likely to do that. We might even fall below 80 in oil excuse me, in the weeks ahead. However, oil remains in a long-term bull market, so I don't want to be short any oil or oil stocks in this market. I want to be a buyer on weakness. Let me jump ahead now to something not on the charts that's out in the news. Australia has increased the tax rate for natural resource companies in Australia. They're going after the windfall profits that natural resource companies have been making there. I think it's a dumb move, quite frankly. However, it is what it is. The big question is, will it hurt big natural resource companies that have a lot of mining properties in Australia? The answer to that is short-term, yes. It's going to take a chunk out of their earnings. It's never good when the government raises taxes, period. And I think it's a dumb move on Australia's part. It's part of the ongoing social move towards socialism, in my opinion, that's gripping the Western world because of the debt crisis. Over the long run, however, I don't believe it will make one iota of difference for natural resource stocks, especially Australian shares, because they have so much money to be made over the years ahead on natural resources. If they have to pay a few more dollars in taxes to Australia, or if other countries follow on Australia's heels and do the same thing, it's not going to amount to a hill of beans over the long haul. For those of you who are concerned about Australia's moves, I don't blame you, but do not let it shake you from the long-term trend here. These companies will easily be able to withstand a higher tax burden over the months and years ahead as natural resource prices continue to climb dramatically higher, and currencies around the world. It's not just the dollar that's losing purchasing power. The dollar is going to lose the most purchasing power, but all fiat currencies are going to lose purchasing power in the next few years dramatically as governments around the world hyperinflate to inflate away their debts. So stay tuned to my column, to my Real Wealth newsletter, and to my trading services if you're a member. Till next week, this is Larry. Have a good week.